네, 시청자 여러분 안녕하십니까? 한국경제TV 신인규 뉴욕 특파원입니다. 최근에 미국 경제를 바라보는 시선이 심상치가 않습니다. 피치는 미국 신용 등급을 강등했고요. 무디스는 미국의 은행주들에 대한 신용을 무더기로 하향했습니다. 추가 경고도 내렸죠. 일련의 이런 사태들이 최근 강세장에 대한 변곡점인 건지 아니면 그냥 지나갈 자극인 건지 월가에서도 의견은 엇갈립니다. 오늘 이 자리에서는 미국 최고의 매크로 분석 독립 리서치 기관으로 꼽히는 22V 리서치의 데니스 디부셀 설립자 모시고 자세한 이야기 나눠보겠습니다. Great to meet you again, sir.
All right, good to see you.
So first, we're going to hear your outlook for the U.S. economy for the second half of this year.
So the U.S. economy, we think, is going to continue to grow at around 2% pace on a real GDP basis. The economy coming out of the first half of the year was running at a 2.4% annualized rate. To start the third quarter, the Atlanta Fed's GDP nowcast actually has the economy growing almost as high as 4% in 3Q. So that's a lot of momentum in the U.S. economy right now. That's probably overstating the strength, that 4% that you're seeing from the Atlanta Fed's GDP forecast or nowcast. That's probably overstating the strength. But what we do know is that consumer spending is likely to hang in the 2 to 2.5% range, given where real income growth or the labor income proxy is, given the strong unemployment rate, which is now still at a very low level. Positive net worth impacts. Household wealth has gone up a lot. The stock market has obviously rebounded, so wealth effects will probably support the consumer. And most importantly, the housing data has bottomed. Last year, we had a significant decline in housing data that now appears to have bottomed and will be a positive or has been a positive contributor to GDP. Housing data is not going to accelerate meaningfully from here, and we're certainly not making that call. But overall, the economy has a decent amount of momentum. It appears to be growing at roughly a 2%, maybe a little bit above that pace. And we should expect that to continue through the end of the year unless there's some type of shock that hits the economy.
So you think still U.S. economy is a little bit decent?
Yes.
Nowadays, but let's talk about the Moody's downgrading. Recently, Moody's downgraded a huge amount of the bank stocks. Mm-hmm. How do you think about this?
I mean, anytime there's a downgrade of the banks, it's not a particularly positive thing. But as far as the actual impact on the economy, as long as nominal GDP is running in a, anywhere from 5 to 6% range, which it's running right now, and as long as the unemployment rate is at a very low level, the Moody's downgrade on the bank shouldn't have a large impact on the overall economy. It's probably not great for the banks that are downgraded from a stock market point of view for those particular stocks. But from the overall economy point of view, the Moody's downgrade is not something that we're terribly worried about.
You just said the second quarter's the nominal GDP, but we checked the nominal GDP growth rate of the second quarter is down to 4.7%. Can it be a problem to U.S. economy?
No, you'll probably see that nominal GDP number run at probably a little bit higher than that on a go-forward basis because the base effects for lower oil prices are in, so you're probably going to see a little bit higher headline inflation, which is different than core inflation, headline inflation on a go-forward basis. So you'll probably be a little bit above that through the end of this year.
So your base scenario is still U.S. economy is still robust for the second half of this year? I
would say for the second half of this year, the U.S. economy is going to be okay. It's going to be, I don't know if I would use the term robust. I would say it's going to be growing roughly at trend, meaning, roughly 2%-ish on a real basis.
Then how about the 2024?
That's a great question. In 2024, the U.S. economy is probably still going to be running at a 2% pace, so not much stronger than we're running right now. There is a risk that wage growth or core inflation stays too high and that into 2024 that the Fed has to tighten some more. That's a major question that investors are struggling with right now is will wage inflation, which actually increased in last Friday's payroll report, will that stay at such a high level that core inflation, the measure that the Fed is focused on, doesn't come down enough? And if core inflation doesn't come down enough, the Fed might have to tighten more and tighten financial conditions more. And if they do, then your 2024 growth or GDP outlook will come down. So to answer the question on how strong GDP growth will be in 2024, we have to know with more certainty that core inflation is going to come down more. And we're probably not going to get an answer to that until late 4Q, so maybe in December of this year. Our baseline is that recession odds are roughly less than 50%. So implicit in that is that inflation does come down a little bit and the Fed doesn't have to be overly aggressive. So we would plan on 2% GDP growth, roughly at trend for 2024.
So the CPI is matter.
Yes, yes, particularly core CPI.
So how do you foresee the next CPI or the trend of CPI for this year?
Yeah, so it's a good question. For the next 3 to 4 months, core CPI, which is different than the headline CPI, which would include oil prices, energy prices, food. So core CPI is likely to continue to come down. So the CPI that we're going to get tomorrow will show, very highly likely to show another month-on-month decline, certainly a year-on-year decline. And the rent component of that, so owner's equivalent rent, or the rental component of CPI is still going to come down because it's lagged. So we know that the data that we get from the private market on rents is significantly below what the government shows for rents. So the rent data will come down, used car prices are coming down, goods deflation is still in place, so your core service CPI number will come down through the remainder of this year. All right? Now here's the potential problem. It might not come down enough for the Fed to start cutting rates. CPI is headed lower on a core basis through the end of this year because the influences from rents and goods prices, which are headed lower and are likely to continue to head lower given what we know about private market data for rents and what we're seeing in the data for used car prices and other goods. So CPI is going to continue to head lower over the course of the rest of this year on a core basis. And the question is, will we get the last mile of disinflation from 4 to 3% without the Fed having to do more tightening? And so, yes, core inflation should be headed lower, but it's not necessarily an all clear for the market, meaning a positive, until we know if we can get that last mile of disinflation without the Fed having to tighten financial conditions more.
Okay, and let's move to another detail of the U.S. economy. Recently, the New York Fed released the household card and the debt and data. So by the report, the overall debt of U.S. households increased a little slower pace.
Yep.
But the thing is the credit card, the credit card debt over $1 trillion in the first of the U.S. economy. And even the delinquency goes up again. So how do you think about the data? Is it still have the risk for the household card data or something?
The short answer is no. I mean, those are all in nominal terms. Relative to the size of the economy, it's not a risk. That would be my first answer. Secondly, credit card revolving credit actually declined, right, which is on the credit card spend side. So it's actually a sign of health, and I'll tell you why. If credit card revolving credit use is going down, which is the credit card usage, yep. If that is going down, but consumer spending is holding up, it means that consumer spending in the economy is not credit sensitive. So think about that. Consumer spending is running at a roughly 2 to 2.5% pace according to personal consumption expenditures data that we just got. At the same time, which is above trend, which is above historic trends, and probably a little bit above what the Fed would like. At the same time, you're seeing a decrease in credit card usage, I guess, using that term. So the spending we're seeing in the economy right now is not credit sensitive, which actually is a healthy thing. We can maintain these levels of spending without using credit cards to maintain it. That's important. And you should expect that to continue as long as the unemployment rate is low, as long as real wage growth is positive, which it is right now, and asset prices are stable.
So consumer spending is not deteriorating?
No. It has slowed from a boom last year. It was at a pace that was never going to maintain, but it's absolutely fine and will continue to be fine unless there's some type of shock that hits the economy.
Recently, I think the narrative of recession is reigniting because compared with just a month ago, still many economists think the recession just comes delaying. How do you think? What's on your view on it?
We disagree that it will come just because of the lagged impact of financial conditions tightening. So some economists that are calling for a recession that's delayed are doing so based on the idea that the tightening that the Fed has already done will lead to a lagged, in this case, much more lagged impact on the economy, and then eventually you're going to see that tightening of lending standards, as an example. Higher interest rates lead to a significant deterioration in the economy. We just disagree. The main reason we disagree is because the way that monetary policy works is through the financial conditions channel. The way that the increase in interest rates works is by generally hitting the most credit and interest rate sensitive areas of the economy first. Housing last year had a significant deterioration. It was a major drag on growth. When you think about residential investment as a percentage of GDP, it was a significant drag as interest rates went up. But guess what? Currently, housing data is stabilized. The most interest rate sensitive sector is stabilizing and is now a positive contributor to GDP, and well, much less of a drag. So if the most interest rate sensitive sector has stabilized and financial conditions have stabilized at not too tight of a level, where would the lagged impact come from? Of course it could show up somewhere, but I think it's very difficult to support that argument when the housing data has already bottomed, to say that the lagged impacts are going to have a significant impact on the economy. So the risk of a recession, in our view, is not about the lagged impacts from monetary policy tightening. It's about the Fed having to do more.
If the Fed do more and there's a risk goes up.
Yes. Yeah, so the main recession risk is not with the lagged impact from tightening. It's with the Fed having to do more tightening in the future.
How do you read labor market data? Recently, the U.S. economy, the labor market is still robust. Even the leisure and hospitality never gets cooled down. How do you think about it?
It's probably the biggest risk to our forecast is that the labor market stays too tight and it forces the Fed to tighten more. So I talked a little bit about wage growth potentially staying at too high of a level. That's directly related to the labor market being unusually tight right now. We are through full employment on any measure. And if you have a very tight labor market, which we do now, and economic growth is running above 2%, then there's upside risk to inflation. So the way we think about the labor market is the risk that it remains too tight for longer and it leads to the Fed having to tighten financial conditions more. And we should not expect the labor market to loosen up meaningfully, although it can, but we should not expect it to deteriorate meaningfully as long as you have demand growth running around 2%.
So now check the gap between the think of market and the Fed. Actually, the market want to believe the further rate hike is gone, but still Fed sticks the position data dependent. How do you think, what are the important factors to think Fed's funds rate path, the terminal rate?
Yeah, so I think it's a good question. I think the Fed funds rate path and what the market is pricing is a slow decline in inflation over time. And wages that come lower in a labor market that doesn't remain as tight as it is today. So implied in the future Fed funds futures curve is continued easing in the labor market. Easing in the labor market. You have seen job openings come down. You have seen quits rates come down. But we haven't seen the unemployment rate go up. So I guess what the market is pricing, if you were to put a finer point on it, is what's called immaculate disinflation, where wages can come down without the unemployment rate going up. And as that happens, core inflation comes down. The last mile of disinflation happens without the Fed having to tighten more. And the Fed can then slowly ease and move the federal funds rate back to neutral, right, which would be lower than the current level. So the neutral rate, or the equilibrium interest rate, or the kind of terminal rate over a longer term basis is estimated to be in the 3 to 4% range. And the Fed can move back to that level if inflation's coming down towards their target. Then that's what the market's pricing.
Also, then what are the things the investors should focus on the next Jackson Hole meeting and further FOMC?
Well, I think investors need to really focus on the things that the Fed has made very clear that they're focused on. And they are data dependent right now. It seems very obvious that the Fed is focused on the labor markets and tightness in the labor markets. The Fed is very focused on core inflation, ex housing and ex auto. So any data on inflation, ex housing, ex auto is important to them. Most of that's going to be driven by wages. And so the most important factor is just to maintain focus on what the Fed wants to happen. The Fed wants inflation to come down towards their forecast, okay, on a core basis. For the end of this year, their forecast is 3.9%. For the end of next year, it's about 2.9% on core inflation. So actual core inflation needs to come down in line with their forecast. And if that happens, theoretically, they don't need to raise rates more and eventually can cut. And if that doesn't happen, then they would have to be more aggressive. So what all investors need to focus on is, are the leading indicators of inflation coming down, which increases the odds that actual inflation on a core basis comes down in line with what the Fed is forecasting. The Fed is forecasting 3.9% this year, by the end of this year, roughly 2.9% next year. And if inflation is tracking towards that, expect the Fed to not hike anymore and potentially cut rates in the future. And if inflation stays above those numbers, then they would potentially have to tighten. So focus on their forecast, focus on their goals, and that's what we need. That's what investors should be focused on.
By the data we have so far, do you think there's a possibility that the Jay Powell goes to a little bit hawkish in this Jackson Hole meeting?
No. The data has been for, I think if he's going to be more hawkish, it'll probably be December, January period, if it becomes obvious by that time that inflation is not coming down enough. But for September, the odds are pretty low that he comes out surprisingly hawkish. We'll see what payrolls do before that meeting. We'll see what CPI does before that meeting. So we have a few more reports to go through. But they would have to be extremely strong. The trend in core inflation is lower right now. And as long as the trend in core inflation is lower, and the federal funds rate is, plus 5%, then there's no reason for him to be more hawkish than expected for now. So expect the Fed to pause in September.
So let's sum up about the U.S. economy. As the best macro firm, macro research firm, what kind of the data do you most focus on? Are there any things that investors ignore or overlook them?
Household net worth in the U.S., so this includes home prices, stock prices, deposit, increased deposit growth, increased by $35 trillion from January 2020 to today. So that positive household worth impulse, plus the positive labor income data, supports spending at current levels despite a 5% plus federal funds rate. And I do not believe that people focus on that enough.
Thank you for your great answer. And let's move on to U.S. stock market. By the first half of this year, Korean investment in the foreign stock market is over $74 billion and surged 34% year over year, and most of portion is U.S. stock market. So, and actually the U.S. big tech, the Tesla and Meta, you know, yeah. So do you think investing in big tech is still a good idea?
Depends on your time frame. So I would say that over a longer term horizon, which I would say over a 1 to 2 year period, investing in a big tech is still a good idea. The companies are absolutely extraordinary. They're the most positive cash generating machines we've ever seen in investment history. So whether it be Apple, Google, Amazon, et cetera, the cash generation from these firms is like nothing we've ever seen before, and there's no reason for that to change. So if we're in a positive economic growth environment and inflation is slowly going back to the Fed's target, investing in big cap tech is going to be absolutely fine over a 1 or 2 year period. Now, through the end of this year, I'm not sure that there's much more room for tech to outperform. Certainly the big cap tech, they've had an extraordinary run. They've gone up a tremendous amount off the lows of last October. And so I do think there's probably some consolidation in the large cap tech names through the end of this year. And we would be more focused on small caps, deeper cyclicals, and deeper cyclicals defined as energy, materials, and industrials. And some other idiosyncratic themes like retail names that have been unfairly punished by inventory overhangs earlier this year. So either very specific themes, like I just mentioned with retail, some transports would fall into that category. We like deeper cyclicals through the end of the year, energy, industrial materials. We like small caps relative to large caps, all through the end of this year. And again, on a longer term basis, it's going to be very difficult to be short NVIDIA, Microsoft, and these companies that are game-changing, cash-generating companies.
So it sounds to me that the short-term, the big tech investor is not a very good idea. If you invest in the big tech, you need to face, right?
Yeah, I mean, I wouldn't say it's not a very good idea. I would say that they have some time to consolidate. Okay. Yeah, you know, I mean, it's not everything can go up every day, right? So investors need to realize that certain stocks are not just going to go up every day. They've had a very healthy run. We'll see what happens with earnings next year. They're all going to be fine. They're all great companies. It's just time for some other companies to benefit from higher odds of a soft landing on a relative basis.
That's kind of risk. And how about invest in fixed income, like the TLT, or even Korean do invest in TMF, that means three multiple leverage. How about the idea of the invest in fixed income market?
Yeah, if I were to be investing in the fixed income market, I'd be long the short duration treasury bonds. And I would probably be short TLT. So I think 10-year yields are going to be biased a little bit higher from here. I think 10-year yields are going to be biased a little bit higher from here. Not a lot. I think not significantly, because odds of a soft landing are higher. And if we're going to go on to the next expansion, then 10-year yields are likely to move up a little bit. The short end of the curve is likely to come down, so you're likely to see 2-year rates come down, and the net result will be a steepening of the yield curve. So we view that the yield curve is going to steepen, and so it would be a little bit more favorable to shorter duration treasury bonds, 5 years and lower versus 10-year bonds right now.
Thank you for your great answer. And that's all for today's interview with Mr. Dennis Dubucher, the founder of 22B Research. Thank you so much.
Thank you.